Lectures, guys. So 1-4 investment process. Come on guys. Investment process. So the investment process is about last time I already mentioned one of the important concepts is portfolio, which is a set or collection of assets. We call them. Let's add a new term in finance, guys. Penalties, guys, 2 penalties for you. Alright? Asset class equals, I mean, you can't just do this kind of stuff. You can't just keep talking. Walk outside, do your talk, and then get, when you're here, you don't listen. So, asset class is the same as investment class. So, some professionals simply call it asset class, some professionals simply call it investment class. They are perfectly substitutes, and it is just a matter of preference. In the literature, there is no preferred term. So, the investment class is stocks, bonds, real estate, currencies, and commodities. Alright, so the next one is portfolio rebalancing. So first of all is the concept which I covered, if I remember well, asset allocation. So asset allocation is the choice of weights for each asset class in the investment portfolio. So an asset allocation is a set of 5 weights that equal to 1. Alright? Now, rebalancing is the process of changing the weights in the different asset classes in the portfolio. For example, when the environment becomes more inflationary, it is a natural investment response to lower the weight of your bonds and to increase the weight of inflation hedges like commodities and gold. Well, the process of lowering the weight for one asset and raising the weight of another asset class is called portfolio rebalancing. Question?
So, in a time of period of inflation, you should?
Well,
is it recommended?
Yes, it is recommended. So when you have an inflationary environment, especially accelerating inflation, then it is recommended that you increase the quantity or the weight of inflation hedges in your portfolio. Real estate is one inflation hedge, and second inflation hedge is commodities, and the third inflation hedge are commodity-related stocks. In other words, gold mining companies, oil companies, etc. So this is a general recommendation which I provide as one example of rebalance.
And to lower the bond...
Yes, and lower those assets which are vulnerable to inflation. So usually the most vulnerable to inflation are fixed income assets, especially which are not inflation protected. Because you have bonds, but you have inflation protected bonds called TIPS. So they will provide a partial protection from inflation. Now the textbook will tell you that they provide a full protection for inflation, but the answer is certainly not. They provide as much protection as the CPI, or the index which is used to measure inflation, is realistic. Usually, whatever the inflation is, the US or any other government will significantly underreport the true inflation in the economy. So, it provides or it underprotects you by the underreporting of inflation. Alright? I mean, if inflation is 10%, and they report only 5, you're going to get compensated for 5, and for the other 5, sorry, you don't. Alright? Alright, let's see what else we have. So, I think I did last time. Let's do it again. Security analysis is an investment analysis of or applied to securities. Securities in finance, we mean financial instruments or financial assets as opposed to real assets. And the preferred methods in modern finance profession is fundamental analysis and second, portfolio analysis. The other three, if you remember, are behavioral, cyclical, and technical. Alright, so this is security analysis. Essentially, security analysis, by the way it's defined in the textbook, is extremely misleading. It involves, it says, the valuation of securities. Well, what does the word valuation mean? The meaning of valuation is fundamental analysis. In other words, what you are misled to believe is that security analysis is only and entirely about fundamental analysis, and the answer is it's not. It is about all types of investment analysis. Fundamental is one of the 5 fundamental types, and if you're going to be providing analysis and you want to be making money, meaning to be a good investor, you'd better use all 5 at the same time. Alright? Otherwise, you're going to be like a one-eyed man who's just looking a little bit on the left and doesn't see what's going on the right at all. You'd better see what's going on. You'd better have, when you're investing, eyes on the back of your head too. You got to be able to see everywhere the full picture. Alright, let's see what else. Top down, bottom up. I remember I covered it last time. 1.5 section. The next section is 1.5 is the markets are competitive. Now, yes, markets are competitive. This is very true. What is even more true is that it's even harder to make money by investing. In other words, unless you are highly sophisticated and you know what's going on and you know what you're doing, you're likely not going to be making money. It's much more likely going to be losing a big chunk of money. In finance and in financial theory, however, this is not what they're talking about. They're talking about if the market is truly competitive. In economics, it simply means that it is efficient. Have you guys studied a lot in your previous finance course, a lot about efficient markets? Yes, or in economics. So, efficient market simply means that all available information on the market is incorporated in the current price. There are 3 forms which are not going to be discussing: weak, semi-strong, and strong. This is coming down the road in portfolio theory. So, if it is efficient, essentially this means all information is already incorporated. It means you cannot trade and invest on information. Alright, so the next concept, which is basic, is that of diversification. What's the question? No, competitive certainly means efficient. If the market is competitive, therefore it is efficient. If it's efficient, it means that the asset is priced correctly on the market. In other words, efficient means that there are no overvalued assets on the market, and it also means at the same time that there are no undervalued assets on the market. This means that all assets are correctly priced on efficient or on competitive markets. That's what it means. This is the implication of efficient. Now, the next concept is that of diversification. Diversification simply means that by adding more assets to the portfolio, to a portfolio, by adding more assets to a portfolio, even though each asset in the portfolio may possibly have a higher risk than the average of the portfolio, adding one more asset could potentially reduce the overall risk of the portfolio. So, the next key concept is risk, and risk applies to a single asset. It also applies to an asset class, and it applies to a portfolio. Now, what you have to understand is that one asset may have a very high risk by itself, but inside a portfolio it may have extremely low risk. The risk of an asset, it depends or is measured by its own volatility. What you study is called sigma. But the risk within a portfolio is measured not by its own volatility, but by its covariance to the portfolio. So the correct measure of a risk of an asset to a portfolio is its contribution to the portfolio volatility. And its contribution is measured by its covariance with the portfolio. Well, the covariance of an asset to the portfolio is called beta. Beta usually designated by the Greek B. So beta measures the covariance of an asset to the overall portfolio. Alright. Now, when beta is less than 0, in other words, when an asset is negatively correlated to a portfolio, this simply means that it actually lowers the risk of the portfolio. We call this asset risk a hedge. Hedge, yes. Hedge simply means that it lowers the volatility of the portfolio. Hedge. So, an asset with a negative beta is called a hedge. This is the meaning of a hedge. Alright? So, let's see what else. So, now back to diversification. So, diversification is the fundamental concept that as you add assets to a portfolio, the overall variability, we usually measure it by the variance or by the sigma, the portfolio will go down. In other words, you have two types of risks, which I'll be getting to: diversifiable, non-diversifiable. You've studied them in portfolio theory. And this is essentially, all of these are part of the so-called modern portfolio theory. Theory is what chapters 4 through 8 represent, which I plan to cover from weeks 3 to roughly week 6. From 3 to 6 chapters, so I'm not going to discuss a lot more than that. Alright, so what does, let's define more terms. Passive strategy, and therefore becomes, I'm looking on my textbook, chapter 14, management. In this particular case, we're talking about passive portfolio management. So, let's try to define a definition. Passive strategy is a strategy which uses a passive portfolio management. Passive portfolio management, passive simply means that you do not attempt to select particular stocks. in order to outperform the market, you simply attempt to mimic the market. So all you do, if you believe that S&P 500 represents the market, all you do is take a proxy, something that correlates extremely well with S&P 500. For example, for commodities, we call it, let's introduce it because we will be needing it for this course. It's called CRB index. So CRB stands for Commodity Research Bureau Index. This is an index devised by the Commodity Research Bureau, which is an institution designed to study and research commodities, which consists of 15 exchange-traded commodities and provides an equally weighted portfolio of the prices of these commodities. Alright? So this represents roughly the fluctuation of the commodity market. So you may try in, let's define the next one, active. In an active investment strategy, you attempt to choose those assets which are most likely, in your investment opinion, to outperform the market. So, if you're an active investor, you say, well, I think, you might say, that silver is likely to outperform. Next, uranium is likely to outperform. And wheat is likely to outperform commodities in general, and gold. So, you're going to invest in all of those 4 commodities. That will be active. Passive is, you will simply invest in the CRB, or an instrument which most likely will approximate the CRB, and you're not going to try to beat. CRB is called the commodity index, alright? Dow Jones or S&P will be a stock index. You also have a bond index.
So passive strategy is basically investing in CRB index?
No.
No?
No. Is investing in a very large index. Passive may be investing in stocks. I never said that it's in commodities. I provided one example with commodities. Passive strategy will be, let's say, an Asian stock index. An Asian stock index will contain 20% Japanese stocks, the Nikkei, 20%, let's say 10% the Hang Seng stock index, this is the Hong Kong, 10% the Taiwan market, 20% the Chinese market. So what you try to do is provide a big proxy of all Asian markets and you invest in them. So passive simply means you do not try to beat the market that you're trying to invest in. So it may be with anything. You may try North American markets, which includes both Mexico and US and whatnot. You may try emerging markets. So we have a proxy for Brazil, Russia, India, and China. We call these. You guys never heard of this? BRIC before? No?
Yes.
BRIC. Oh.
Brazil, Russia.
Brazil,
India.
Russia, India, and China. These were the emerging economies that were expected to conquer the world a year ago, right? Now they're mostly in recession. Alright, so, in other words, you're trying simply to use it. Now, you're going to be using passive strategy if you believe that markets are efficient. So, if the market is efficient, it will be stupid to use active strategy, because if the market is efficient, it implies that you can't beat the market. You use active strategy when you believe that you can certainly beat the market. Active strategy is more costly because there is cost of management. Active management has always higher transaction costs, and it always has higher information costs. So it costs a lot to do research, and it costs a lot more to manage an active portfolio. With a passive portfolio, all you do is create the portfolio once, let's say the S&P, and then lie back on the beach and the portfolio works for you, all right? So active is costlier, and unless you're sure you can beat the market, it is plain stupid, meaning unjustified from a cost-benefit point of view to invest. Question?
S&P, you mean the Standard and Poor?
Yes, S&P means Standard and Poor's, not poor. Poor's.
Okay.
Yes, Standard and Poor's has a large number of indices. The standard, the most common, is Standard and Poor's 500. Because there are a lot of different, there's 600, there's a lot of them. So Standard and Poor's 500. All right. Let's see. The next section is the players. All right. So who are the players?
We are.
No, you are hopefully the future players. All right. So number one is firms. Firms go on the financial markets to finance themselves. We call it to raise money. They can raise it with debt, they can raise it with equity, they can borrow loans, which is technically debt, but they can issue short-term instruments, long-term instruments, whatever. The next big player is households. They are, at least up until recently in all textbooks, the ones who provide the savings to firms. Firms is always synonymous with businesses. In economics and in finance, there is no difference between firms and businesses, and you can choose and use whichever you like as a matter of preference, all right? Business sounds more English, firm sounds a little more foreign, right? We also use it in Bulgarian language, firm, all right? It's a lot shorter. So households is the same as family. Family, all right. So households usually supply the savings. So they are the savers. All right. And then you have the government.
The third one?
Yes, is the third big player is the government. The government always borrows. Governments in the world are never savers. They have never been in history, and it's extremely unlikely to be savers. Governments are experts in spending, like women. Alright? So governments always borrow. And these always borrow. Now, let's clarify something. Alright, so these are the key players. These are the final players. In the meantime, you have intermediary. So, an intermediary sometimes stands short for financial intermediary. So, financial intermediary is an institution.
Like Falcon over here. Falcon.
What is Falcon?
That's a new financial intermediary over here.
Oh, well, yeah, I mean, it's like they're literally, yeah, I mean, you can provide 1,001 examples. I can provide 20 examples with Bulgaria, but you would have never heard about them. So, financial intermediary is a financial institution which channels funds or resources from savers, in other words, from those with excess funds to those with a deficiency or shortage of funds. So these are, now let's try to clarify why the definition of the textbook, how the definition of a textbook in financial intermediary is wrong. So financial intermediary, to bring lenders and borrowers together. And the borrowers together. Yes, they're connecting. The problem is the word borrower. Borrower, let's clarify. Borrower implies debt. Is that fairly clear? Borrower provides debt. Well, financial markets and financial intermediaries, an example of a financial intermediary is an investment bank. So when you say borrower, you certainly mean debt. But financial intermediaries also intermediate in equity. Alright? In equity.
Lenders.
Well, that's why you cannot say lender. That's the problem. I'm trying to explain for you why the textbook uses a bad terminology and how you should learn to use and understand the terminology correctly. Lender means someone who provides debt. But financial intermediaries don't provide debt only. Financial intermediary provides both debt and provides equity. Alright, is that fairly clear?
It is.
So, debt is associated with borrowing and is associated with lending. But intermediaries also provide equity. Now, the financial institution which provides equity, meaning issues or generates or creates equity for the first time on the market, is investment bank. Alright, so investment banks actually do not specialize in borrowing and lending, although they do this certainly. They specialize in issuing equity on the, how do we call those particular markets? Yes, but how do we call the markets? Primary market. So the next key concept is that of a primary.
Hold on. Sorry.
Yes, let me finish and I'll hold on. And secondary. Okay, question.
Would you, I mean, can you simply explain the intermediary or give me a simple definition for it?
Yes, the definition of intermediary is a financial institution which channels funds from those with surplus of funds to those with a shortage or deficiency of funds. So I am working around the problem of debt and equity by using the key word fund, which is the most general. In other words, when they say lender, when they say borrower, they mean debt only but not equity.
Sure. Because
debt and lending certainly means excludes equity. Alright? So, to work around, we say funds. Alright? So, funds could be in the form of both debt and equity. Alright? Funds is the same as, you can use a new word with financial resources. Those with excess financial resources channel it to those with a shortage or deficiency of excess resources. Is that clear now?
yeah.
More questions? No question. Alright, so now we're talking about primary and secondary markets. When we say primary and secondary market, we mean primary and secondary financial market. So primary means that the security is issued for the first time. It involves the creation of the security. Secondary means that security which has already been issued and has been raised is sold from one current owner to another. So it is already trading. Now, raising funds, remember, raising funds happens only on the primary financial market. Funds are raised. On the secondary, there is no raising of financial funds. Alright, let me take a look what else I have. So, investment companies, credit unions, we're not going to study those. Institution, primary, secondary, reputational capital. And yeah, that's pretty much it. So, next time, for the next two lectures, we have chapter 2, which is financial instruments or financial securities. That's good enough for today.